Traders Library is proud to present the Trade Secrets video series. Taped live at industry seminars featuring the world's top names in trading, these instructional tapes provide key insights into the world of trading. The first of its kind, this exciting series is supported by additional educational material, including detailed charts, tables, and other visual aids to help you advance your trading skills. The Trade Secrets video series is a truly comprehensive series for traders, featuring top traders like the legendary Jack Schwager, whose new video, Winning Methods of the Market Wizards, is the perfect companion to his 3 classic Market Wizards books. Pristine.com's Oliver Velez. His swing trading and guerrilla trading tactics videos will help you spot fast-breaking opportunities using the successful Pristine method first outlined in his best-selling book, Tools and Tactics of the Master Day Trader. Steve Nissen and his Strategies for Profiting with Japanese Candlesticks video, providing an in-depth step-by-step course for applying this powerful and popular charting technique. Industry leader Price Headley's high-impact options trading video highlights powerful methods for achieving big option profits through superior stock selection. It's a great complement to his new book, Big Trends in Trading: Strategies to Master Major Market Moves. For more information on the Trade Secrets video series or any of our additional investment-focused products, visit our website today at www.traderslibrary.com or call 1-800-272-2855. Traders Library, your #1 source for great everyday low prices.
Join David S. Nasser, founder of MarketWise Trading School, as he presents precision trading techniques, strategies for combining price, volume, time, and velocity. Nasser delivers an innovative workshop that will leave even the most advanced trader wanting more. A must-see for the serious technical trader.
Thank you. Thanks, John. Hi. Hi. You guys ready to get to work? Because that's what we're going to do. We're going to go to work. We're going to go right into this. We're going to get into charts, methods, and probably most importantly, ways of seeing the market. And what we're going to think about while we go through this and what we're going to talk about is what we call structure and form. Markets formulate pictures of what it's saying about itself. It's psychology, it's crowd psychology, the picture of the market consensus of value, the intensity behind that intensity, or consensus of value and volume, the way in which stocks trade, or other financial instruments are all going to be seen through a series of screens that really explain what we call foundational analysis, a term that I think we coined, but I'm not certain, but I'm pretty sure we did. But not on ideas that are new or inventive. These are concepts that are based on essentially what comes off the exchange floor. So what we're going to try to do is explain to you what exactly traders look for on an exchange floor, and then how do they adapt and also overlap with the technical approach that you're all very familiar with. Foundational analysis begins with price, volume, time, velocity. If we can understand those things, those foundations, those cornerstones of the market, we can understand how to trade the market. We can understand how to control risk. We can mitigate emotions from it. We can become objective about the market, not subjective, and we can see the market for what it is, and that is simply a reflection. And these are key words, a reflection of crowd psychology. The very things that drive markets are given to you through those 4 foundations: price, time, volume, velocity, in no uncertain order. And as we go through this approach, what Brian and I are going to do is share with you the ways that we see the market from a company level, as well as what we try to do each day as we go through the markets. So what we're going to do is take you through each step at a time. What we have to begin with is ask the question, what really moves the market and also how does it move through its various stages, which we're going to talk about shortly. We look at the markets, we think of the traditional methods of market analysis. Foundational analysis that I mentioned earlier is simply a derivative of what we always have thought about traditionally. We talk about the fundamental approach, the technical approach. These are the common two different sides of the equation, or two sides of the coin, that we're taught through the years of study that we've all probably put into it, or if you have not yet studied the markets, this is what you're going to hear traditionally in the textbooks, the classes, and so on. And what we're going to talk about is a really forgotten market segment that really represents most likely the most profitable entity or group of traders that really have ever existed in our history of the stock market, and that is the floor traders. The traders that are on the New York Stock Exchange, the specialists, the market makers, the participants on the floor of the Mercantile Exchange in Chicago. These players make their livings. These traders trade every day with large sums of capital, but rarely do you get a chance to look inside their heads and find out what it is that they're looking at to make their decisions each day. Some would argue that it's order flow, it's customer order flow coming in through the exchange floors, whether it's over the telephone years ago or now in more electronic means through systems like SuperDot or other electronic methods. But in reality, making money on order flow was only part of the way they made their livings. And what I mean by order flow is, as customer orders came in to either buy or sell the issue, these traders would recognize the imbalance of supply and demand that would develop on the floor and act accordingly. If an oversaturation of demand came in the face of diminishing supply, stocks have to go higher, or options have to go higher, or whatever the financial instrument in question, futures contracts have to go higher. So all instruments follow this law of supply and demand. It's not the idea of supply and demand, it's not the concept, it's a law. And floor traders look for these imbalances on the floor of the exchange. What we've done through our foundational approach is we've brought this practical common sense approach to the market into the technicals and also address the issue of the fundamentals. The fundamentals that you hear about, that the fund managers are going to study, the bottom-up approach, is the company have a good product? Does the fish taste good? Can they catch it, freeze it, deliver it, and sell it quickly and efficiently? That's fundamentals. How's the management talent? That's fundamentals. What are PE ratios? Those are fundamentals. These are things that fund managers are going to look at for longer-term views of the market. Fundamentals are the true lagging indicator of the stock market. They answer the question, why? They tell the story why certain things occur. They are what the newspapers love to write about because people want certainty. They want to put some kind of answers behind certain market action or dynamics. Why did the market gap up or gap down? Why did Intel trade down 5 points after releasing good earnings? The fundamentals will come through. Their inventories were growing. They lost a large sale to an institutional level customer. These are the things that you're going to have to learn to really think about when you look at what do stock prices do and what moves them. Fundamentals answer the question why. As traders, we cannot afford the lagging relationship of fundamentals to what the market's going to do tomorrow or the next day. We can't afford that. We can't afford to wait to find out why something did what it did. We have to know and anticipate with some degree of certainty, but not total, what is about to happen. What's the propensity for the market to do tomorrow, the next day, or next week, statistically? And what we do is we begin to introduce the concept of technicals or statistical analysis, a form of technical analysis. And these are the things that we have to do as traders because ultimately, in order to make money in the stock market, we need to anticipate. We need to recognize the next move. Are there a wave of buyers soon to follow our buying activity? Are there a wave of sellers soon to come after we've sold? If those conditions can't occur, then we can't make money. And that's paramount. We're going to add a third, which you don't see yet on the slide, which we call foundational analysis, which again brings the floor trader's perspective in and blends it with the technical approach. And this is going to be our method. So first let's start with a technical approach because it acts as a large piece of our analysis, and then we're going to blend in the foundational piece of price, time, volume, and velocity. If we can bring those together and marry them, we have a method of trading that is consistently profitable for those that will have the discipline to follow the rules of engagement of this approach. Technical analysis, what is it? Technical analysis is the art of following flow of money, people's money, primarily through the use of price charts for the purpose of forecasting future price trends. Forecasting, that's what we do. Now, there's different ways of forecasting and reacting, but whether you follow the trend and join the trend, or you anticipate the changing trend, the reversal, the bottom line is that participants need to follow your activity in order for you to profit. Second bullet, a belief about the values of current prices versus historical values. Where do buyers and sellers tend to live or congregate? Metaphorically, think of it as a neighborhood. In which part of the neighborhood does it become dangerous? In which part of the neighborhood is it safe? Where are the buyers and sellers going to live on the charts? Well, you can get a picture of that. You can get an idea of where the statistical likelihood of stocks moving in a certain direction are. And charts represent the beliefs of traders. That's the psychology. And in the end, these beliefs, these overall consensus of value that forms is the psychology and the supply-demand relationship all in one picture. That's trading. So I talked about this a little earlier today, but I'm going to tell the story again because it's a good way to talk about the fundamentals. Where do sardines come from? Do they taste good? Well, the story goes like this. A young gentleman came in from Ellis Island as an immigrant, chasing a capitalistic dream, looking for a way to make money. And the net of it is he was able to borrow a case of sardines from a merchant on the docks down in Lower Manhattan and was able to sell those sardines for a profit in one day. Over the course of the next couple of days, he was able to borrow several cases of sardines and over time was able to make enough money to buy a truck and sell the sardines out of the back of it. Over 20 or 30 years, he built an empire of distributing sardines. He was the largest sardine distributor in the world. And as he got older, he wanted to hand the business over to his oldest son. His son one day walked into the factory, opened up the can and tasted them and spit them out and said, "Dad, these taste terrible." His father slapped him in the back of the head and says, "You idiot, understand one thing. Sardines ain't for eating, they're for buying and selling." And if you can understand that, you can understand fundamentals. We don't really care what the stock looks like, what it tastes like metaphorically, or whether it's a good value or it's not a good value, whether the company has the opportunity to make money or not. The dot-com era taught that to us. What we care about is, can we buy them and sell them? Can we make money trading them? So fundamentally, we can't get hung up on what is a good or bad value. How do we make money? As I said, we have to be able to buy stock and have others follow us. And on the short side of the market, we have to be able to sell stock or other instruments and have others follow us as well. If those things can't happen, we can't make money. What we're going to talk about is this herd mentality, because that's really what we're talking about in the market, is this mentality of participants and the mentality of traders and how do they act as a group. And if you look at this way, a very simplistic approach, think of the white sheep as the overall masses. Most participants are the white sheep. Most people act in a similar fashion. They're looking for certainty. They want it in the news. They want to be able to hear it on CNBC. They want to be able to read research reports. They want some kind of confirmation of the decision that they're about to make. And if they can't have that confirmation, then most of them will stand aside or they'll gamble and guess. But most participants don't act without certainty. The reality of it is that traders, in order to make money, act almost on complete uncertainty. When I say uncertainty, I mean in terms of knowing the outcome of what today's trade is going to bring, because no one does know. But what I'm talking about is doing it with an edge, doing it with a statistical likelihood that markets are going to move in a certain way. And once we can understand that, we become actually the black sheep. We become the independent thinkers about what the statistical likelihood of stocks are going to be tomorrow and the next day. And we're going to trade that edge to our advantage. Now, it's interesting. We're here in Las Vegas. And you might ask the question in the game of craps, why is the number 7 reserved for the casino? Well, it's a simple answer. I think this gentleman's already answered it. This is a statistical edge. The number 7 has more possibilities of coming up than any other number combination when you throw a pair of dice. It's simply that fact. Number 7 comes up 6 possible ways. And no other number can come up as many ways. So that small edge, that small statistical edge, is what the casino owns and keeps and reserves and maintains that so they can build pyramids in the desert. And that's what it takes to make money. But I'll tell you this, they don't change their rules. The craps dealer does not change the rules in the middle of a game. The craps dealer does not play the game any differently than they played it 1,000 times prior. Because the casino has rules. They say this is exactly how you play this game, and there's systems. Those dealers become the system. They are the system. They're cyborgs. There's no subjectivity. There's no input on their own. They follow a rigid set of rules that builds these pyramids in the desert. And as traders, we have to act the same way. We have to have a methodology of trading the markets, seeing the market in a certain way, recognizing where that edge is, and trading it like a system every time the same way. So that over the course of 100 trades or 1,000 trades, you do the same things. You follow the same rules. Not putting arbitrary inputs in like your feel or your hope, and certainly not your greed and your fear. And if we can understand that, we can begin to set the mind of a trader and think like one of the black sheep, the independent thinkers. And this is really the beginning. Now, I know everybody's in a hurry to get to the charts and see the certainty that we hope to find on these visual images that show structure and form. But the reality of it is that if we can't build the foundation of your own psychology first, then the charts are going to be lost to us. They may as well be as predictive as reading the stars. We have to understand where those levels of buying and selling strength exist, where the psychology behind it is, and recognizing what the propensity for them to do the next thing will be for the next trade. Where do those buyers and sellers live, and why are they there? If we can understand that, we can learn to deal with also another important facet of the market, and that's the dynamics of the market. What drives the market dynamically that you haven't seen before? See, the things that don't change is the psychology. Patterns will change. Things will look differently than you had seen before. Again, the dot-com era taught us that lesson as well. We saw things that we had never seen. So how do successful traders navigate through this dynamic market? They understand the driving force of psychology. So we look here at a chart, and we look at the novice trader, the white sheep, making decisions based on emotion, and we ask the question, what do the white sheep do? Well, what we've got here is we've got obviously a very large rally, and we've got the participants that contribute to that rally. But what we also have is we've got a standout candle. For those of you not familiar with candles, simply a way of graphically looking at the open, close, high, low. But we have a graphical representation of the psychology of the candle, and we're not going to get into technology in terms of how to build different candles. We're not going to talk about what candles are specifically. We're going to talk about what drives those, because you can do that mechanically on your own. They're very simple. But the ultimate point that I want to make is that this represents a picture of psychology in the way the markets act and the way the herd acts. Now, the question is, do we want to be in those scenarios where the markets make these dramatic mistakes? Well, what we have to start to do is build up how do we become objective versus subjective. How do we deal with the market that is dealing with emotions all the time, yet not being emotional ourselves? And we look at this in a couple ways. In the objective analysis, the black sheep analysis, we look at simply conditions in the market that are not influenced by emotions or personal prejudice or what you think the market should do. We're going to try to look at things that feed that objectivity. And we're going to let others feed their analysis through subjectivity. And derivative indicators, while we do use them, they're not really driving forces in our decisions. They are supporting our decisions. Oscillators, stochastics, relative strength, directional indicators, ADX, things that we use, but not things that make our decisions. Things that confirm basically a simple approach to seeing this psychology and therefore seeing the market. As you see here, we look at the overall levels of the market and we see there's all kinds of ways to become subjective. We've got moving averages. We've got support and resistance levels. Let me first say that support and resistance is as subjective as you want to make it. Where you might draw a support line and where I might draw one are very different. On what time frame? And what's it reflecting? The support for today, next week, next month? We really have to ask the question, how do we quantify these subjective inputs to really arrive at where do the buyers and sellers most likely live? If we can do that, we can take much of the risk out of trading, which is job one. So what we're going to do is we're going to start to look at these charts differently. We're going to start to recognize, what do the charts tell us? What are they about? Here we see the spiders, the exchange-traded fund on the Amex representing the S&P 500. We all know the product. Great product for trading the overall market trend. But what we really also see is we see some things that are often neglected by traders. We see volume, which I know we all pay attention to, but what we don't really see is what are the volume and price relationships as they occur in real time. What does a floor trader do when the phones start ringing off the hook on an exchange floor? How do they react? What I'll tell you is the first thing they want to know is where is the buying sentiment or selling sentiment? Which side of the crowd's in control of the supply-demand equation? That's going to drive their decisions, and they won't wait very long to react to it. The charts really say the same thing with real-time data, a relatively new evolution of trading, that we have this ability to put real-time data into charts to tell us where they live. Same thing a floor trader would do. So as we go through, we're going to talk about psychology quite a bit. And what we try to do is recognize what is the mind of every trader that's making money focused on. They tend to follow these things. Either consciously or unconsciously, they look for the comfort of numbers, the law of large numbers. Volume is going to be that consensus and confirmation of how strong support and resistance may be, wherever it may be. They avoid taking risk unless they have some view of the market, because in the absence of not knowing where these levels exist, trades should not be put on. We must know that long before the trade's put on. They feel that if others are buying, then it's okay to buy. This is the amateur mentality. They're waiting for that confirmation. They want to read about the gap ups or the 5-point run in a given index or a stock. They want to see it in the papers. They want to see it on television before they make the trades. What we're going to try to do is talk about how we can anticipate the white sheep mentality. They act on the advice of so-called experts, and they act on the advice of gurus, research reports, subscription services that promise one winning trade after the next, stock tips, and so on. All the activity of the white sheep, the amateur mentality. As humans, they tend to complicate the process. I want to tell you that trading's not that complicated. I mean, certainly stochastic calculus can be complicated. Certainly mathematical algorithms can be written. Certainly you can take this to the nth degree, any degree that you want in complexion, but the reality of it is the markets are relatively pretty simple. They're simply about where buying and selling pressures build and release themselves throughout the day. Amateurs want to always make the same mistake twice because they want to get revenge in the market. Now, don't show your hands, but how many times have we lost money in a given stock and stayed with it because we wanted to get back at that stock subconsciously? We wanted to beat this stock. We wanted to buy it back so we can sell it for a profit or vice versa. We have to move on. We have to recognize that when the statistical edge passes, we have to pass along with it and move to the next trade. Now, again, a lot of you are sitting there impatiently waiting for us to get to the juicy secrets of the market. You have to discount that right now. They don't exist. What we're going to get to is how to read these structures and these forms in the market to recognize what markets are prone to do next. Once again, the novices are entering at the wrong time. Let's talk about this for a little bit. For example, we see in this particular area areas of sellers or supply. Simplistically, what's the first indication of that supply? This market structure shows indecision. This market structure shows a balance in supply and demand. That's all. Buyers and sellers are agreeing at this point. There's no real consensus of value. For the buyer, there's a seller and vice versa. Let's make it real simple. Can a stock go any higher as long as there are sellers at $25, for example? Simply cannot. Because if you and I want to buy the issue, there's no way the issue can go to $26 as long as sellers exist at $25. It's that simple. Why would we pay more? We wouldn't. And conversely, can a market go down as long as there are buyers at $25? Simply cannot. Because if we are holders of stock and we want to sell the shares, why would we sell them below $25? As long as there are participants willing to buy stock at $25. Again, it would not. So it's the laws of supply and demand. Real simple. We all know that. But the question is, really, what is the price-volume relationship saying about these structures in the market? And if we can recognize these things, we can discount the fact that we don't have to pick the top or bottom. We don't have to be so right so quickly that our trade decisions reflect being on target at the exact moment a stock's supposed to go up or down. We have to recognize the levels and the range in which these markets trade, the support and resistance levels. And as we do, things become a lot clearer. And we're going to get to this shortly. In this scenario, as we can see, buyers tend to be late, and sellers, again, tend to be late. What we have to ask the question is, these ranges that exist that really represent the sexy part of the move, the part that everybody kind of sees when they look at charts in retrospect. If I only could have bought here and rode the rally. Don't think about that. It's impossible consistently to do it. We have to ask ourselves, what part of these moves can we take out of the trade with a higher degree of certainty in terms of the statistical edge, not the certainty you read in the papers, but the certainty of recognizing that there are sellers in control of this stock right now, and what's the likelihood that they're going to follow it through to lower levels? Well, the black sheep now has to step in and answer some of these questions. They have to say, where is the independent thinker? The black sheep, the independent trader, the successful trader, leads the herd. So rule number one, learn how to anticipate markets and recognize that participation leads to higher risk. The longer you, or the more you participate and the longer you wait for confirmation, the greater risk you take. So the question becomes, but what about the rule, the trend is your friend, which means I should wait for some trend to evolve and trade it? Completely true, but on what time frame? Today's trend, yesterday's trend, last week's trend, last year's trend? So we begin to quantify these things as we go through some more slides, and we recognize that anticipating on the short term is the recipe for success, not participating once the move is already in play. Most traders need to tune out the subjective noise that they get from support and resistance, research papers, advice, and they have to become independent thinkers, which means that every one of you have to learn how to do this on your own. There is absolutely not a service on the planet that's going to make you any money. Maybe for a week, maybe for a month, but any time that you put the decision-making process in somebody else's hands, you are absolutely opening the door to losses, sooner or later. We have to be independent thinkers. We have to learn how to identify the proper entry that most people never see. We have to buy after a period of selling. In other words, rule number two, we have to learn how to buy weakness, sell strength. Somewhat different than what most people see the market as. And same on the short side, we have to sell during a period where most people are still buying. That's liquidity. Let me give you a perfect example, the gap up. Again, let's go to the floor traders, the professionals. Why do markets gap up? Why do we have limit days where markets open up or down where there's a large gap between the closing price the prior day and what we're opening up at today? The answer is simple. Because market makers, we'll talk NASDAQ for a second, market makers love to open a stock up in the face of seemingly good news that comes out after the close, which is where most news comes out to the street. The news is released, certainty is now in play. Papers pick it up. The websites pick it up. The internet. You name it, the news. This news gets disseminated, and market makers do what? They're going to gap it higher. Why? Because the participants are going to react to that seemingly certain information that's going to tell the stock's future for the next day, i.e. trading higher, is going to be put out there for sale at higher and higher prices so that the market makers can have the liquidity to fade that market. Now, does that mean we're going to fade every gap? Absolutely not. We need confirmation in other ways. But the point is, the reason that a market will gap one way or the other is that every market maker on the planet is going to anticipate the participants or the amateurs to overreact to that and be liquidity. Whether they're gapping it up higher, in order for them to get short, they need buyers to come into the market. If they're gapping it lower, then just the opposite is true. It's the whole purpose. The whole purpose is to make money. So good traders have to recognize to think like a contrarian to the market and not as a normal participant as most of us have been taught. Successful traders can identify opportunity before others, and they execute their plans also before others. Let's talk about the black sheep. The successful traders see the levels of resistance building, and they react. They're buying fear. They're not selling it. They're reacting to and acting in a way of anticipating the next trend, the next rally, whether it be a short-term or even a mid-term trend. So what we try to do is we try to look at the market in this way And this really begins to form a much more objective level of support and resistance. When I see traders drawing trend lines over the perfect tops of prior highs and under the perfect bottoms of prior lows and calling them support and resistance, I cringe. It's what everybody's seeing. It's what the white sheep are looking at, the same things. What we have to ask is, what's the price-volume relationship of that? And most of that's going to occur at levels that really don't appear classically on charts the way you'd think that you draw support and resistance levels. And that's because, and remember this, stocks move the most on the least volume. The gap is the perfect example. Now, as trends develop, we always say that volume confirms trends, and that's true. But if we're going to anticipate trades and moves in the market, we're going to recognize that most large moves are going to occur on the very least volume. And the gap that we just talked about is the perfect example. Is a gap play a very large volume play? Yes or no? No. A gap play is probably the perfect example of the least volume play, because markets that gap higher are doing it on almost no volume or very little volume. Now that we have post-market trading, I'm going to take some questions toward the end as we get through, but I'm going to probably make a lot of points that maybe your questions address. But the point is that a gap is a perfect example of a low-volume rally. We're talking about up gaps. So what we have to ask the question is, why is that the case? Well, here's the answer. Markets gain velocity as it loses volume. What's that mean? It means that markets move very rapidly through price levels on very little volume. Do you ever see a stock move $5 in a very short period of time with very little trading actually going on? Show of hands. That's a high velocity, low move. Question is, would you have caught that move if you had not anticipated the move?
Why does that?
Why does what?
Why does it?
We're going to cover that. The question is, why does that happen? Well, in a few slides, I'll give you a visual picture of why, but quickly, before we get there, simply because the supply-demand imbalance becomes so out of balance so quickly that when buyers are demanding issues in far extremes, great extremes over selling pressure or stock for sale, supply, then the demanding buying crowd is bidding up the stocks dramatically in the face of very little stock for sale, which is why they're bidding it higher. You've seen the auctions, and by the way, that's what the New York Stock Exchange is. It's an auction. The specialist is the auctioneer, and on that floor, and by the way, at every single price level that trades, every trade that happens in the New York Stock Exchange is nothing more than a miniature little auction at every price. And if the buying sentiment on the floor is so strong that there's no sellers offering stock for sale, then what's going to happen on the floor with those buyers? They're going to do what? They're going to bid higher to try to bring out sellers. And therefore, as they bid prices higher, let's say they're bidding them higher in 10-cent increments. What's happening is prices are now moving in 10-cent increments, not 1-penny increments, what we call becoming thin. And as that occurs, if sellers are still not yet incented, and the specialist bids the stock even another 10 cents up, now maybe even 20 cents or 30 cents or 40 cents up to bring sellers out of the crowd, prices are moving rapidly, but there's no trades going on. There's no consensus of value. Sellers don't believe it's a good time to sell. Buyers think it's a good time to buy. Demand over supply, big move in price called velocity, very few trades going off, low volume. And therefore, if we cannot anticipate these areas of volume drying up and then building, we can't anticipate the levels, what we call saturation points. And when markets find levels of great consensus, where there's lots of trades going off with great volume, we recognize the market is closer to becoming saturated or closer to becoming in balance with each other than it is just the opposite. And we all know that to make money in the market, we have to make money as prices rise or fall. We don't make money when markets stand sideways unless we get into option techniques, which we're not going to do. That's outside the scope, but there's certainly strategies there I want to talk about, at least give credit to, I should say. But we're talking about anticipating price action in the market and recognizing the move. And this is all going to start coming together closer and closer as we look at these charts. So now we begin to look at what we call the reversal candle, or an invitation to get short, and we recognize what the black sheep or the independent trader is thinking about, the professional trader. And what's the invitation for this trader? And we see here, we recognize that after large moves such as this, we're actually looking for the volume to start to dissipate, not to grow. We're trying to recognize the first signs that the market is starting to change its opinion. This is the classic reversal play. We're looking for the sellers to start to come out of the crowd, not come into it. So what we're doing is we're saying that the move that most people are looking for at this stage of the game, had you not been in the trade, you've missed it. Good traders are recognizing and anticipating the next coming move. And they're getting into the markets before they occur. Now, if we're talking about swing trading and longer-term trading, and those are important as well, then participation becomes a much more important topic. But as traders, I want to tell you this. Every trade that I make, including a swing trade, I want to anticipate. In other words, I want to act like a day trader on every swing trade. You know why? Because I want to be right almost right away. I want to be in the money almost right away. I don't want to carry a lot of heat and take a lot of pressure, heat meaning losses, in order for the trade to materialize. I want that trade to work quickly. And then I want to afford myself the peace of mind of profitability to let my trades carry me into the future, whether it might be a day trade or 2 days or 3 days or even 5 days. And I want to let stops and certain other conditions that are outside my control, the market itself, let me decide if I can stay in or get out. But ultimately, I want to anticipate every move, even when swing trading. And that'll make more sense as we go through. In other words, I want to be right very quickly, not wrong. If I'm wrong in a swing trade, I can't rationalize the trade and say, well, I got into this with the idea of holding on for 3 days. Under what condition? What drove that decision? If a trade goes against me $0.50, and in my mind it's a swing trade, is that an excuse to hold on to the trade? There's no way. Good traders are going to be making money very quickly in every trade. Whether it's a day trade and you get stopped out, or it's a swing trade that allows you to carry it into the next day, the market will determine that. Let me tell you something. This is really important. The market is like a human organism. It needs to be fed, like you do. It needs food, and it needs nourishing food. The problem is most food given to the market has already been digested before you get it. Now, I'm not going to tell you what happens to digested food. You can figure that out for yourself. But if you're relying on that information to make this trading decisions, you're far behind. The fact is, most market food, most market information is either extremely rare to come by or it's illegal to have. Which means the only nutritional value in the market is going to come from the technicals and your ability to read it. It's not coming from the newspapers. So as we go through here, we want to think about that. We want to ask the question, what's the amateur doing and what's the professional doing? And what I'll tell you is that most books that you read, most classes that you'll go to, and most people you'll talk to act like the white sheep. In other words, get rid of conventional thinking. You want the proof? Most people lose money in the stock market. Someone said to me last night, hey Dave, is it true that 90% of the people lose money in the stock market? You know what my answer was? Wow, I didn't know it improved. It's a fact. We're not going to deny that because it's the fact. And why? Because most of the books you read, most of the classes you get are talking about the stuff that makes such good sense. Support, resistance, breakouts, breakdowns, confirmation of a stochastic, overbought, oversold. It's literal, it's logical, it appeals to your logic, and you react to it. But the fact is, that's not the way market makers trade. That's not the way the specialist trades. Do you realize that the specialist is legally obligated, legally in terms of the rules of the New York Stock Exchange, to be a buyer of weakness and a seller of strength? It's called affirmative obligation. They have to be a liquidity provider against the trend. Now think about that. They've got to be buying when the trend seems to be selling. And they've got to be selling when the trend seems to be buying. Affirmative obligation. Why? And do you think that the New York Stock Exchange specialists that are on the floor aren't making money? They're making money. You might think, well, they have the inside track. They see the book. That's not true. They do see the book. That's true to a degree, but that's not why they make money. The specialist makes money because the specialist is standing in the face of adversity all the time. They're buying the tail ends of weakness, and they're selling the tail ends of strength. And they're doing it as volume starts to contract. And if that volume is not contracting, then that specialist, while they may be selling stock into a strong trend, will be doing it much more passively with lower volume and less aggressively. But when you want to see a specialist get aggressive, you're going to see it as the sellers are starting to dissipate from the crowd. When that happens, they want to be in there buying. But they're still buying weakness. They're buying the fading market. They're buying a market that's dropping still, but finding its level of support. They're buying the classic rounding bottom if you saw it on a chart. And this is where we want to go. We want to get you to understand that these pictures of the market are just representations of foundational analysis. They're buying prices that are falling, but falling with less velocity and less volume. And that's where you want to be recognizing your opportunities in the market. And that's what the professionals are doing. The professionals are acting like the black sheep. They're standing in the face of adversity, and they're using price and volume primarily over everything else to confirm that. If anything else is getting in your way, stochastics, RSI, directional indicators, MACD, you're making huge mistakes. You're basically acting like a Pavlovian dog. We've all done it. Not you individually, but us as a group. Because we're being given signals, and we're reacting to those signals, and we're forgetting about what's really important, which most people don't see. Price volume, that's it. If you could read price volume, I don't care if you read it off the tape, or I don't care if you read it off the charts. Hopefully you're doing both. If you can recognize the information that is coming across on the charts and the tape, you are so far ahead of the crowd. And it's pretty relieving not to have to get fixated on all this technical jargon and indicators and sea of information that's just nothing but a diversion from what's real. You don't see traders in the New York Stock Exchange running around with laptop computers, okay, looking at charts. They have electronic devices to make trades, execution systems, but not decision support systems. Their decision support systems are what's real and what's in front of them. So let's get into it a little bit deeper now and recognize, where do these market structures develop in the market? What do they look like? Oh, sure. We've seen them. Channels and support resistance and buy support, sell resistance. Come on. We know that doesn't work. 90% of the people lose money because it doesn't work. What we really want to look at is we want to recognize, where do amateurs respond? And what I'm talking about here is what really drives an issue down or causes a rally. And here's where some of the information comes in. As we said, like Pavlov, traders are going to act in a very, very conditioned fashion. One conditioned fashion is this. If you were a buyer of shares somewhere near a market top and the market went against you, fear says that we're going to stay in as long as we can. Actually, that's not correct. Hope says that you'll stay in as long as you can. Fear will get you out when you can't stand it any longer. Human emotion will say that the next chance to get out, if I haven't sold yet, if I haven't been called out in a margin call, says that the next exit hatch in sight does what to those holders of stock? It shakes them out immediately. They're weak holders. They remember the pain they went through. They remember the margin calls. They remember watching their account drop dramatically. The first remnant of what we call R1 or resistance 1 shows itself up very quickly because they're weak holders of shares that cause them a lot of emotional pain, and they're going to act in an emotional fashion, a conditioned fashion, and they're going to blow them out very quickly. I know that sounds simple, but that's number one. If you could recognize where those levels are, I want you to trade them every single time. I'm going to help you see them in a minute. So what we want to recognize is that support really doesn't live down at these levels that we all perceive them to live. Support lives at levels where markets really have already made their moves, made higher highs, and they trade into higher lows, meaning that a good trader wants to buy weakness into pullbacks, and they want to sell strength when markets retrace, when they drop. And we want to recognize where are those weak traders or weak holders of stock shaken out, and where are they likely to be back. In this case, these weak holders of stock live up in these areas. Now, the question is, can the market get rid of them quickly enough to hold levels of support? And if it can, the propensity of the market is to rally. Because once the sellers are out of the crowd, supply-demand equations tell us that if demand does exist and supply is starting to dissipate, prices have to rise, regardless of the fundamentals. So we're going to start to look for these levels in the market. And what we start to see is, what does a market do? What are the four things that a market can do? And this actually goes back to the 16th century. This goes back to the business cycle in its earliest form. You know what the business cycle was originally? And maybe it's not the original business cycle, but it's certainly one of them. Sunspots, predicting the way that crops would grow because it was a key currency. Crops, agriculture. And sunspots determined the business cycle. Was the business cycle of crops going to be strong because the weather was good? Were we going to have drought conditions causing fear and ultimate decline? It's a business cycle in any market, in any time. It's the basis of capitalism. Markets are going to build and accumulate. They're going to find a point where demand takes over supply. They're going to distribute those profits as profit takers take them. And they're going to get to a point where ultimately supply takes over demand and causes decline. And they're going to do it again and again and again and again, over and over and over and over, cyclically. So the question now has to be this: what stage are we in? And if we could just start to answer that question, we could basically take the odds and put them in our favor right from the start. You could start to trade number 7 metaphorically in the craps table, because statistically it's the best number. Well, in this case, if we could ask the question, what likely stage are we in? We have a 1 in 4 chance of being right just throwing darts, because that's exactly what markets do. Now, the next thing we have to do, though, to quantify, is to really determine, where do we really want to be players in the market? Where do we want to participate? And the answers are, we want to monitor and watch closely the price-volume relationships in stage 1 and stage 3, but we do not want to participate. We use stage 1 and stage 3 to anticipate. And once we do react, what we're anticipating is either a stage 2 markup or a stage 4 decline. And if sufficient information does not exist to give you a statistical edge to anticipate stage 2 or stage 4, you simply do not make the trade. I call it radar. If your radar doesn't go off, if you don't see it, if you can't recognize it, there's no trade. And perhaps your radar goes off 15 times in a day, Jeff. Perhaps it doesn't go off once in a month. That's just a condition of seeing the market and recognizing opportunity with experience and time. But you're going to have to ask the question, did the radar really go off? So let's start to look at how do we quantify this. And I know I've taken a long road to get to this point, but the foundation of what we're talking about, the psychology behind it, is far more important than the technical indicator or the green and red lights that go off on certain computer systems that tell you when to buy and sell. It's crazy. All that is an automated algorithm based on historical values of when buy and sell signals should occur. Come on. The market, we know, is way too dynamic. It changes way too often. We know that what may have worked yesterday doesn't work today. If you don't believe me, call up John Merriweather from Long-Term Capital, the world's largest hedge fund. Where are they now? They're out. And they would have been out quicker if the Federal Reserve wouldn't have bailed them out during the ruble crisis and the Asian flu. The point is that the quantified systems, quantitative analysis, automated systems that feel they can mathematically quantify every possibility didn't work for long-term capital. It's not going to work for you. And trust me, they've got a lot more money to spend on brilliant minds to help quantify that. So if there was a way to get there, they'd have found it. The reality of it is the only way to condition yourself is to recognize the psychology of markets, and the psychology only does 4 things. Show me any chart, anywhere, in any issue, and I'll show you the same thing. We call stage 1 accumulation because this is the particular time where shares are starting to become accumulated, and they generally occur after downturns, but not always. Brian's going to talk later about when charts get sloppy, and stage 1 really isn't stage 1, it really falls back to stage 4, which means you're anticipating a rally off a big sell-off, but the market breaks down once again, looking for support 2 or S2, another lower support level. We'll talk about that. But the point is that regardless of how it happens, structurally the market can only do these 4 things. There's complicated ways of looking at it. Elliott Wave has an approach of looking at these different levels. There's all kinds of ways of getting there, but the methodology is correct. The idea is correct of seeing the market in terms of psychological form and structure. But ultimately, if accumulation truly is in place, and there is a balance of supply and demand, there is consensus of value, ultimately the dominant crowd will take over, demand will step out in front of supply, and we'll move into markup. That will happen. Till we finally reach a point of distribution where sellers step into the market and distribute their shares, and certainly lead to decline. Or higher highs, which is really a continuation of stage 2. So now we have to begin to try to confirm some of this structure. And by the way, if you could accurately, I'm saying accurately, if you could accurately quantify market structure, I mean accurately, I'm just hypothetically speaking, if you can consistently and accurately recognize market structure, would you use any technical indicators and all these complicated formulas and mathematical systems and computerized programs that give you buy-sell signals? Or would you just say, hey, looks like we just moved into stage 2. The market's going to rally. I can buy Yahoo at 320, sell it at 360, and it wouldn't matter about the fundamentals. It wouldn't matter about anything. So simplistically, all we have to do is recognize statistically what is the market most likely to do next. That's it. If you're doing more than that, you're working too hard, and trust me, you're getting too little in terms of results. We'll talk about risk management in a little bit because ultimately, all we can hope for is to be right slightly more than we're wrong. I mean, what do you think the win rate is here at this casino? Believe it or not, the win rate is not as much as you would think, but the profitability of the little difference between their win rate and yours is huge. So if the casino only has a 2% edge, while not a big, huge edge, an incredibly profitable one, I'll tell you that our traders show us consistently that their win rates are 55, 60, 65, 70%. You give me a trader with good discipline with a win rate like that, I'll give him my money to trade, and I have. Because that's all it takes. And all you have to ask yourself is this question: could this be one of the 40% of the times that I'm wrong? And if the market breaks a certain level, says that's where you're wrong, you told yourself before getting into the trade that's where you're wrong, move on, cover the trade, move on. Well, we'll talk about how we set stops, entries, exits all around these structures. And we're going to begin with a top-down approach. We're going to look at these different pictures and these different structures on various time frames to ultimately form a top-down approach or a top-down view of the market. We see right here Intel on a daily chart. Right now, in this particular area, now it's easy to say what it looks like, but in this particular area, we look like an obvious stage 1 accumulation. It's that simple, following a decline. And what we have to ask the question is, every time we look at a chart on any time frame, always ask the question, what does it look like in terms of the price and the volume? For example, if the market sold off on deep, deep, deep volume, high volume, and suddenly the market began to start to show lower volume levels, but prices were still falling over the course of, say, 3 days, what does it tell you? That's all you get. That's all the information I'm going to give you. What would it tell you? Less sellers. Sure. On the floor of the exchange, the phones are ringing like crazy. The orders are coming down to the floor. They're selling the shares. They're distributing the shares. The market's getting pounded. The phone is not ringing as often. What would you do? You ever see the movie Speed with Keanu Reeves, where the dynamite's around the guy's neck? And he says, what do you do? Okay? What do? Where are you going to run? You got dynamite on your neck. Okay? You got to do something though, right? It's decision time. The question is, in the absence of better information, what are you going to do? You're going to buy. And that's what you have to start to look at the markets as is, when do I make these decisions? And what information do I use to make them? Now, here's Intel on the same chart. That was a daily. Here's Intel on an hourly chart, 60 minutes. And we see the same exact picture that we just saw. We see this accumulation range of a retracement in price, a retracement in volume, and now the market suddenly lifting on almost no volume at all. How does that happen? Well, it happens a lot of ways. Let me take a quick little tangent here to give you one example of answering the question why. In other words, fundamentally, let me tell you why an issue might rise in almost no volume. Tax loss selling. You go into year end, how many times have you seen shares of, say, a $10 stock fall deeply below the $5 level really rapidly and ultimately then rise rapidly right after the first of the year? You ever notice that? Want to know why something like that happens? Because institutions are starting to unload their shares in these low-price securities. Institutions don't want to carry low-quality stocks in their portfolio for the year-end tax statement and year-end annual statement, which is their biggest statement of the year. So they blow out their laggards. They blow out the stocks that aren't popular, that aren't in the S&P 500, because they're all indexed. They blow those stocks down lower. And the amateur crowd perpetuates the sell-off. You know why? Because they're the recipient of that downturn. On hope they hold on the longest. And then all of a sudden, all the accomplices step in and help them get rid of the stock. The broker calls and says, hey, you got a margin call. That's an accomplice. Guess who's the next accomplice? The wife or the husband, the spouse. You go and say, hey, we're getting our heads kicked in here. I got to put more money in. And the spouse says, oh, no, you're not. Get rid of this thing. We're not putting more money into this thing. There's another accomplice. That's not bad enough. You show up at your accountant near the end of the year. You want to get ready for taxes, and he says, hey, you know, there's this thing called tax loss selling. You can take the loss. We can write part of it off. As long as you don't buy it back for 30 days, you can take the loss. What do you say? All right. So now you got the broker, the spouse, the IRS, giving you all these opportunities to take this loss. You don't think the institutions know that? And they know that you can't buy it back for 30 days. So what do you think they're going to do at the turn of the year? You got it. They're going to be all over that trade. That's simple. And you know what? When 30 days are up, the revenge factor steps back in. Oh, that damn stock. But look, it rallied from 5 back to 8. I'm going to get back in. It's back. I knew I was right. And there's the uptrend I knew was coming. And there it goes again. Starts all over again. And guess what? They become the liquidity for guess who? The professionals that are now doing what? Going the other way. Simple psychology. It's not hard. You just have to think about it. Well, on the charts, we start to answer the question why, like I just did there. But in reality, what we really need to do is watch the indications of what's happening. The reasons why are intriguing and they're great stories. You love to talk about them over the bar. You love to read about them, but they're not going to make you any money. We have to recognize the signs of why before why is explained. Because again, there is no market food of any nutritional value before the market responds. The market has already responded in price. It's already digested the information before you get it. Which means the only nutritional value is price action in the market. In this scenario, every single time, if I saw a high volume sell-off into low volume where the sell-off lost some of its velocity and started to stabilize and started to rise on very low volume, I'm a buyer almost every single time. End of story. I call the trade with risk management. I say I'm wrong right here. If it breaks down, I'll blow it out for a loser. If I'm right, I'm going to put a trailing stop on it and I'm going to ride this baby. And that's it. Pretty much that simple. Lots of stuff that I'm going to throw at you in a few more minutes to help confirm it, but that's it. The foundation of that is that simple. So what we're looking for is how do we quantify some of these things? Well, we're going to quantify some of this through the use of some moving averages. And what we do now is we begin to say, okay, can I trust this? Is it just that simple, Dave, or is there other ways to trust it? Well, there is. We quantify it. And what we look for here is how do we quantify some of these moves? And once we do that, we can then start to apply some moving averages to it under the auspices that it took a little while for this moving average to build itself. If it's a 10-day moving average, it takes 10 days of data. If it's a 20-day, it's 20 days of data. So we have to give it a little more relevance the longer it takes to build, because it builds a perception value in the market, because all the white sheep are looking at this moving average. That's the only value in moving averages, by the way. It's not mathematical. Let me tell you why. How many here would agree that the most recent past will have the greatest impact on the most near-term future in the market? Show of hands. You're correct. How many believe the distant past loses its effectiveness in predicting the moves that are about to come? Sure. Well, a simple moving average is not a very good mathematical way of following that logic, because if you're looking at a 200-day moving average, do you realize that when the first day drops off because the 201st day came in, the value of the first day dropping off is equal to the weight of the 201st day coming in? It's the same value. It's not weighted. Yet we're putting as much credence on the first day that started the 200-day moving average as we are the 201st day that happened yesterday. Mathematically, it's a terrible formula. Measures nothing. But do people watch it? And do they react to it? Absolutely. You can't argue with the math. It is what it is. It's objective. But we can all agree that the perception value of the 200-day moving average is what? It's huge. So you can't argue with the psychology of the market. It's not the mathematics, it's the psychology. So what we're going to start to do is recognize what these moving averages tell us over different time frames and what the relationship they do have to price in predicting what stage are we in. Are we in a stage 1, 2, 3, or 4? Moving averages tend to act as support in an uptrend. They tend to act as a resistance level in a downtrend. They help, more importantly, quantify what stage are we in. Is the market in a stage 1 or a stage 3? If it is, we want to study it. We want to use it to anticipate the ensuing stage 2 or stage 4. And we want to be aware of the direction of the moving average as we look at that. So what we have here is we've got a moving average chart that starts to quantify certain moving averages that seem to work better on certain time frames. On the daily, we see the 10, 20, 50. On the hourly, we see the 8, 17, 65, and 130. Well, it's not hard to figure out that the 65-period moving average is the same as the 10-day moving average because there's about 6.5 trading hours in a day. So if we're looking at 10 days of data, we have a 10-day moving average. If we want to look at 10 days of data on an hourly basis, we look at a 65-period moving average. It's the same thing, right? Everybody with me? So we just keep the relationship somewhat log normal as we go through the different time frames. That's all. And all we're trying to do is recognize what these moving averages are telling us in relation to price and, more importantly, in relation to market structure. Are we near stage 3? Anticipating stage 4? Are we accumulating our shares, getting ready for stage 2? Or are we going to further break down and really be a continuation of stage 4? Well, we start to do that by looking at these charts with this in mind. And what we begin to recognize is that the markets really can only do a couple things. So what we've done is we've broken it down a little bit further than just stage 1 through 4, but we've asked ourselves the question, well, are we in early stages of stage 1? Are we kind of mid-maturity in stage 1, or are we late maturity in stage 1? And if we are entering stage 2, is it early markup? Is it mid-markup or late markup? Are we early distribution, mid-distribution, or late distribution? And are we early, mid, or late decline? So where are we within these levels? And we try to do that by quantifying what a moving average relationship looks like. Now, by the way, these are the core elements that start to build some of the indicators that you read about, like MACD, moving average convergence divergence. Moving averages is simply taking a series of moving averages, 3 of them to be exact, and quantifying a fast versus slow line. Fast line is going to be the shorter term moving averages because they're going to move quicker. And the slow line is going to be the bigger moving averages because they move slower. They're like big freighters because they're like 200-day moving averages, or they're like 50-day moving averages relative to maybe a 10 and a 15-period moving average. That's all. And when the slow moving average crosses the big moving average, they have a cross and it gives you a signal. But why? What does it mean? What's it really say about where the buyers and sellers live? Do we just want to literally buy them when they cross or sell them when they cross? No. Well, what we did is we made it more simple than that. We said, let's tear apart the indicator, not that indicator specifically, but the concept of what it tries to measure, and just ask the question, when we look at a series of moving averages, what do they mean in relation to each other? Here's an example. We look at a 10-period moving average that's greater than a 20-period moving average, that's greater than a 50-period moving average. What does it mean? What does it tell us? Let's think about that for a second. What we've got here is we've got the 50-period moving average basically last on the chart because we've got the 10-period above it, and we also have the 10-period above the 20-period moving average. So what do you think? So we've got this 50-period moving average that really just got what? Penetrated. So we probably have a downtrend in the market overall that took enough time to bring the 50-period moving average down to some level, right? That's what drove it down. And then all of a sudden, prices that also led the charge would be reflected most quickly where? In the 10-period. And then the 20. And suddenly then the market has a wake-up call over the next day or two, and the 10-period moving average decides to lead the charge the other way, the reversal. Perhaps a transition from what? Stage 1 to maybe stage 2. And all of a sudden the 10-period moving average rallies hard and travels all the way up through its 20-period moving average, and the 20-period was brought along the way, oops, and the 10-period rallied so hard it brought the 20 with it, and did what? Caused it to start to move and ultimately act as some kind of gravitational pull to suck the 50-period with it, but hadn't done it yet. So the short-term fast line just blew right through the longer-term slow line. That's it. There's one example of quantifying where certain levels of the market live. And there's only 6 possible combinations when you're dealing with 3 moving averages. Mathematically, there's only 6. That's it. Those are it. So what we've done, and we have limited time, we've tried to quantify these relationships, and we try to flowchart them out in all these possibilities. Write these down. I'm going to go through them kind of quickly for you. Okay? 50, 10, 20. This is where you want to take some notes in your book, okay? 50, 10, 20. I think it's on your book. We're going to go right here. I'll go through the first one, okay? 50, 10, 20 is a stage 1, 1. Stage 1, early accumulation. I'm going to give them to you in order. I'm going to give them in no certain order, okay? 50, 10, 20 is a stage 1, 1. Just write these down, we'll go through them. 10, 50, 20 is a stage 1, 2. Yeah, so when I say, look here, let's all look up front. When I say 50, 10, 20, I'm just giving you the order in which the moving averages live. So the 50 is greater than the 10, and the 10 is greater than the 20. Okay? So 50, 10, 20 is a 1, 1. 10, 50, 20, just find it on your chart, is a 1, 2. 10, 20, 50 is not so sure. It's either a 1, 3, or it's anything between 2, 1, 2, 2, or 2, 3. The 10, 20, 50 is either late accumulation, which is 1, 3, or it's any of stage 2. Okay? Just write this down for now. We're going to go through it, so just don't try to read into it. Just write it down so you have your notes. Then stage 20, a 20, 10, 50 is a 3, 1. A 20, 50, 10 is a 3, 2. And a 50, 20, 10 is either a 3, 3, late distribution, 3, 3, or it's all of stage 4. Could be early decline, mid decline, or late decline. 20, 50, 10 is 3, 2. You're welcome. And you guys will have all these slides, but we want to recognize what these levels are. But I don't want you to literally recognize them. Here's what I want you to do next. I want you to make a homework assignment out of this. I want you to study this on charts over and over and over again until you can look at the charts and recognize what stage does the market look like it's in and see if it agrees with what we just talked about. See if it agrees. See if it has the similarities of the structure we just talked about. And as we go through that, the reason why the 10, 20, 50 and the 50, 20, 10 are a little bit more complicated is because we also have to look at this in relation to what its prior closing prices were. So what this does is this kind of answers those two unknowns. So we have relative certainty in this quantification. In other words, the 50, 10, 20, the 10, 50, 20, the 20, 10, 50, and the 20, 50, 10, we know that those are in definite stages of development. What we don't know is the 10, 20, 50, and the 50, 20, 10, what stages are those really in? So what we built, and you don't have to go through this, but what we built is we built a way of measuring that. So we asked questions regarding what the previous stage of development was and what the closing prices of the stock that we're measuring was also in relation to that, and we helped quantify that. Bottom line is you're not going to get this in just a short meeting. What you're going to get, though, is a way of starting to see the market in terms of stage development. We're going to give this to you every day in our services. We quantify this for you. We give you the report. We let you see it, okay? It's very simple stuff. Just go to marketwise.com and bang, we'll provide it for you. So the bottom line is that that's part of our services, but what we really want to get to is this. What we really want to get to is once you learn that in about an hour's time, you're going to ask yourself the question, where are we in various time frames in the market? Now, we're just talking about dailies right now, by the way. We're just talking about a daily chart. I'm not getting into hourlies at this point. But what we're looking at is we're saying, is the market, for example, are we in a stage 2 markup here? Anybody? Clearly. Okay, clearly. And what traders start to have to think about is, most people want to say, well, this bottom here would be early stage 2. Well, we don't think so. We think that markets can move a pretty dramatic way, a distance along the way in a given trend before there's really good confirmation that the rally is in play. In this case, we finally see where prices are breaking through all of its key moving averages, really now confirming the markup is in play. We can trust it now. And this moving average cluster acts as a support level beneath this cluster. So what we've got now is we've got our indications that the long plays are statistically likely to continue, not unlikely. And we don't have to ask the question, are we in stage 1 or stage 3? We know clearly that we're in stage 2. What do you do every single time in stage 2? You buy. And what do you do every time in stage 4? You sell. And if this overall trend line is starting to fall apart, represented by the first sign of prices dropping through some of its key moving averages, we recognize that the maturity of our uptrend is starting to really fade. And if volume confirms that, if volume is dissipating, meaning that buyers are also starting to fade, what do? You anticipate. You anticipate. Because remember, we're in stage 2. So therefore, we're willing to not try to sell the top and wait for some confirmation. Likely, the sell is going to happen below this 50-period moving average in green. In other words, even though this looks like a likely good short right now, because it looks like distribution, nice stage 3, consensus, buyers and sellers are agreeing, people are buying and selling, that's why it's sideways or consolidated. We're willing to wait for confirmation for price to penetrate its support in terms of a moving average cluster to really confirm that the stage 4 is in play. And we're doing the same thing down here in stage 2. Well, it looks like it's the right place to buy. That's hindsight, and we don't get that in the market because where we have to live is over here where nothing's happened yet. We have to ask, what's true confirmation of stage 2? We believe it's price breaking out above all its key moving averages. And we recognize that this confirms that stage 2 is far more likely than any other stage. And if you could say that to yourself, and the data really confirms it without any opinion, then every single time you should make that trade. Period. End of story. And statistically, you're going to be right more than you're wrong. Does not mean you won't be wrong. Does not mean that this particular issue doesn't break down and gap down below its moving averages. In that case, all bets are off. You move on to the next trade. Let's go through a few more and kind of look at some examples of where it can get sloppy. For example, here's the same particular issue, I believe it is. And now we're looking at the issue with a series of stages that we get to see over time. And all we're trying to do is quantify each of those moving average relationships that you can study relative to price and watch what markets do. That's all you can do at that point. What we're going to find, though, is that we get fooled at times. The markets do break down here. So, news may come out and break the overall stage 2 markup trend line. There's all kinds of conditions that you can't account for in the market, except for having a protective stop to take the loss if that occurs. And that's really all we're trying to do at this point, is put ourselves in the likelihood of stage development. If we can do that, we can be more accurate. So on the entry, I'm going to take some questions at the end, okay? Because we're limited time, and I'll take some if we have the ability to at the end. I have a lot more slides I want to cover. The proper entry, we want to look for the lowest risk possible entry with the highest odds with the lowest amount of stress, which means we want to be right as quickly as possible. So by entering at support and resistance before others, we're basically first in line or close to that. Confirmation, what separates the professionals, we talked about that. So I'm going to move a little bit quicker through here to two types of entries. The one is we can be the more aggressive entry, where we're going to anticipate to the point where we're recognizing the turn early on, or we can wait for the classic first pullback, meaning that the markets oftentimes are going to break down and they're going to pull back against their ensuing trend and define ourselves as the first pullback. Now, the reason why we want to recognize this as a lower risk entry, less aggressive, is because, again, same mentality. We've got many players in the market that are selling their shares in the market. Shorts are going to get squeezed into these rallies. These are little minor short squeezes that occur. And at this point, the short sellers are going to be weak holders of their shorts simply because the market's going to rally against them. And that pulls out or creates the first pullback against the ensuing trend line. So there's really more than one way to enter a trade relative to these positions. As a trader, I typically like to scale in slowly and take a little bit of heat if I'm averaging into my trade by not entering my entire position all at one time. I'd rather start shorting into these levels and selling these rallies as opposed to waiting for my shorts to be opened. The problem is that you don't have the benefit of seeing what's about to occur next in reality. And most people have been conditioned to read these charts in retrospect, where they want to see the perfect setup. I'm trying to condition your mind to see it like it really is, when you have no perception of what is supposed to happen next. That's the hard part. So when I talk to students of technical analysis, they're constantly looking for this pattern that their mind has been conditioned to see, but has not yet unfolded yet before they enter. That by nature makes you very late. That by nature makes you the white sheep. You have to recognize these signals before they actually unfold. So these are two classic setups that are great for this type of trading. The aggressive anticipation of the sell-off and scaling in even into the rally, or waiting for the first pullback, but understanding why is it a pullback, not just the fact that it's a pullback. How do prices turn? Each significant price will turn based on an event that causes the prices to turn. Most of these events are going to be known after the fact. That's the fundamentals. That's the market food that you don't get prior to the move. So we can look at a lot of examples of the same concept. In this case, we're looking at the first rally into typical or into supply typically produces the deepest retracement. So in this case, we see a very strong rally up against this ensuing retracement, but these rallies tend to be vicious and strong. Notice the above average volume after the multi-bar advance. The reason why? A lot of these shorts are being squeezed on these rallies, and they're going to be aggressively buying back their shares to cover. We want to recognize that as those short covering issues are starting to come to a close, then that buying sentiment is going to close as well, and those are the examples of the next possible entry on, in this case, the short scenario. So all we're trying to do is recognize what they look like psychologically as well as what drives them. And that's really all we're trying to find in terms of how to read some of the candles that we recognize. They simply represent the range. We'll just go through a few slides here and take you through, because we're running out of some time here, we'll take you through what happens at these levels. And we call it the Venturi principle. Simply reflects the way markets really build their momentum prior to actually making the move. So for example, as volume grows, and this is really kind of bringing it all together from the concept that we talked about, in stages 1 and 3, what you're going to tend to find is that volume is beginning to grow. So for example, in accumulation stages, volume is going to be very high. You're going to see lots of trading going on because buyers and sellers agree and they're turning over their shares. That's why there are trades happening over and over again. What we're recognizing, though, is that once a move does begin to transition from a given stage to the next, so for example, if we're moving from a stage 1 to a stage 2, volume is going to tend to shrink as markets move rapidly. That's your growing velocity because demand becomes so far out of control relative to supply. Demand is stronger than supply, so the buyers are taking the shares higher quickly when sellers are not incented to sell. And that's why those moves are going to occur so quickly. Therefore, you want to anticipate your stage 1 and 3 moves to participate in your stage 2 and stage 4 moves. And this is really where most of the activity of the market is going to occur in terms of profitability. Does that make sense? So as volume subsides, velocity increases, prices change the most. You look at a stock even in a given day, if a stock moves, say, $4 in a day, most of that move, you'll find, as a rule, will occur on the lowest amount of volume. Even though the daily volume may look like 7 million shares for the day, say in Microsoft, if you look at the price changes as a rule, the largest part of the range is going to occur generally on the smallest amount of volume. And then they consolidate, they level off, and they trade large volume as they reach into, say, stage 3. So if in a given day the market moves up dramatically, what we're going to have is a scenario where the market runs hard, runs a $2 or $3 range, starts to consolidate into stage 3 where it doesn't want to run as hard, loses some momentum, but shares are growing rapidly in terms of volume. That's an indication that markets have moved more than their fair share on light volume, and now it's kind of catching up with itself with buyers and sellers agreeing more and more. And that's your indication of some of the momentum slowing down. That's all we're talking about is momentum. It looks a lot like this. I call it the fast burn. Suppose a market moves from 85 to 90 on light volume. This is a trade that most traders are going to miss because the markets are so quick and they're moving on such light volume. Now we see volume starting to build heavily. The bulls are still slightly in control, but we're starting to see the market flatten out. Looks more like a stage 3, thin or a thick bull. What we want to do is we want to anticipate during this stage the next really rapid retracement, say from 93 to 89 on light volume, which is the fast fade. So these moves, if you want to participate in them, you've got to anticipate them by the stage 3s and the stage 1s that precede the markups, or the stage 3s that precede the declines. And that's really why most traders miss trades. Most people are looking for so much confirmation that they're entering most of their trades in the most dangerous part of the trade, which is your stage 1 and 3s. Stage 3, stage 1 generally preceding a stage 2 markup. What we can start to do now is we can start to recognize what are some of the tools that we can use to start to time these entries a little bit better. Well, what we want to look for is we want to look at the extension of that range. Earlier we looked at those candles. We saw those wide wick candles. All you're looking at is a wide range in the actual price of that given share, or excuse me, that given stock, based on the shares that are traded over that day. Wallace Wilder in the mid-70s wrote a system called the Directional Movement Indicator that recognized that while most traditional participants were watching the open-close range of the day, these bars, you saw them earlier in candles, represent a little bit more if you start to look at them in terms of the extension of elasticity when markets move in a certain direction. So for example, in a positive directional movement, if markets can make higher highs, that's more relevant than the open-close relationship because the higher high is an extension of the emotional viewpoint of the market at that point. Emotionally, the market's saying that we're at our highest levels of bullishness in any given day. Second day, the market reaches a new level of emotional high. And that's more important to the market's ability to repeat that action than where the market's closed. And the reason why is that the most emotion in trading occurs at the highs and the lows, and the most volume occurs at the opens and the closes and everything in between. So these levels represent high velocity, low volume peaks in market, which is exactly where most traders get shaken out of their shorts, or if we're talking about lows, the market is as much a bear as it could become at that moment on the lowest volume, and that's why liquidity dries up. For example, how many times have you been long the market reaches a new daily low for that day, and suddenly the bottom falls out, the bids fade quickly, and liquidity is hard to find. It's tough to get out of your long positions. Show of hands. Rapid declines. And the reasons why is the market did just what we just said. The market reached that point where it reached its greatest level of emotional low on the least amount of volume, because as these levels start to get penetrated, as markets find new lows, fear steps in, buyers leave, and therefore the greatest amount of whipsaw occurs. Whipsaw risk, trying to get out of trades that you want to get out desperately at the worst possible time. This is what happens with this liquidity-volume relationship. And that's why, if you don't anticipate, you're going to be caught up in that negative downturn. It's probably a better screen to describe what we just talked about. When markets reach these new crescendo lows, anticipate volume to thin out. If you're long the market while this is occurring, you're going to suffer the greatest losses. So what Wallace Wilder says, and I agree with this concept in his indicator, is that we want to recognize these new extensions of elasticity as indications of where the market is prone to go next. Because emotionally, the market said, we're bearish. And the fact that the market broke that perceived level of support and made new lows says that that's a minus directional movement, and that confirms that if a market can break down to lower levels elastically, it's easier to get there again. Perceptions have been broken, long traders are out of the market in many cases, and some more long traders probably are getting ready to get out of the market based on these new lows, more fear. That's going to cause rapid sell-offs, supply over demand imbalances, buyers dissipating because markets are dropping. Why would you want to be buying into this fear? This is most of the white herd mentality. So there's no bids to hit. There's no way of exiting your trades without the market spreading out and finding deeper levels of loss. And that's why when you watch the markets trade, maybe Microsoft's trading in 1 and 2 cent increments, nice thick levels, and all of a sudden it's trading at 10-cent increments. All of a sudden Microsoft is dropping by 10 cents or 20 cents at a time. You're experiencing a minus directional movement on low volume. It's a rapid sell-off. The tape speeds up. Lots of sellers are there, but not a lot of buyers. So prices keep dropping rapidly until liquidity is found. The point is that once liquidity is found, that's a better sign of the bottom than it is anything else. That's the point. Traders want to participate in that. You want to feel that. You want to recognize that through the way markets trade. This indicator is a nice tool to help you do that, but the point is that like any indicator, when markets really aren't sending a signal, you shouldn't use them to make decisions. You should use them to confirm your decisions. So in this case, we have the zero directional movement indicator, which means when markets really are trading inside of a range, not making highs or lows from, say, day 1 to day 2, then we really want to ignore the signal completely, because there's no emotional extension of the market's bullishness or bearishness. So what do you think that would look like? What 2 stages is that more consistent with? What do you think? 1 and 3. You got it. And in 1 and 3, we don't want to trade. So we want to use that to anticipate either the next breakout or next breakdown. And these are going to be your best ways of recognizing when markets trade in a zero directional range, stage 1 and stage 3. And if we can just look at that, we can begin to recognize how to read the signals. So here's an example. This is just an Excel spreadsheet that I did on Realtick, where I downloaded the price levels of the market within a given day. And in this case, I'm looking at Amgen. And all I'm doing is I'm recognizing where these levels are in the market. Now, the first one I'm going to talk to you about is going to talk about the relative strength index next, which is really just another way of measuring this elasticity. And what relative strength does is it simply measures, and you're going to see a picture of it right here in this squiggly line. But what relative strength is simply saying is, look, based on these ranges that the market trades in, higher highs, higher lows, or lower lows, and so on, the market reaches these levels of being overbought and oversold. But why? Well, one good example of why a market gets into these deep levels of elasticity is because the markets get to that point where fear runs its course and so does greed. So here's relative strength, and you want to write this down. I didn't put it in the slide on purpose. Relative strength is simply measuring the number of up days that a given issue trades in versus the number of down days, and the percentage that the market is up when it's up versus the percentage of the market that's down when it's down. So for example, if you have 10 days of data that you're studying for a given stock, and 7 days are up, 3 days are down, the relative strength is where? With the bulls or the bears? What do you think? With the bulls. But let me throw you a curveball. Suppose in the 7 days that the market is up, it's only up 2%. And the 3 days that it's down 4%. Now where's the strength? With the bears. So what we want to do with this indicator is we want to recognize that that's what the indicator is measuring, which is what Wallace-Wilder also wrote into the system. So what relative strength is measuring is a stock's relative strength or weakness to itself. Maybe a good way to look at this would be like a football field. And what he's basically saying is that at the 50-yard line, the signal is muted. So it really looks like this. There really is no signal. There's no extension of bullishness or bearishness. It's within this stage 1-3 kind of thing that really doesn't show trend. But as you move to one end zone versus the other, the football field analogy, one end zone represents where the bulls live, and one end zone represents where the bears live. And as you get closer and closer to the bullish end zone, as an example, what I want you to think about is, imagine a rubber band tied around your waist, and you start at the 50-yard line. There's a stake in the ground, the rubber band's attached to the stake and your waist, and as you run toward the bullish end zone, the closer that you become, or the closer that you get to the end zone, the greater resistance that starts to build in, because more and more sellers are going to live deeper down the field toward the bullish end zone, because profit-taking steps in. Traders that were in the trade earlier are going to take their profits. More sellers live there. So what RSI is saying is, while these moves occur, and you see these directional movements making higher highs or lower lows, depending on the market trend, as the market reaches these end zones, it becomes relatively strong or weak to itself, which means that it becomes closer to overbought near the bullish end zone and closer to oversold near the bearish end zone. Which means, again, we're confirming exactly what we've described all day today. Somewhat reverse market psychology. You know, the trend is your friend. That's true, but on what time frame? When trends become mature, you want to anticipate its reversal more than you want to participate in this mature trend that you've already experienced. Traders that are already measuring the trend in its mature state, looking to join it, are doing no more than trying to get nutritional value from already digested food. That's what I'm trying to say. And what I'm trying to get across is that these are some indicators that help confirm these overbought and oversold territories. You can see here, for an example, we're looking at Amgen. We see that the RSI is reaching these levels of 71, 71.50. So just think of that as like the 71-yard line near the bullish end zone. These crescendo highs represent where RSIs become overbought, and we call that a sentiment indicator. It's a sentiment that they're overbought, the bulls have run too long, and therefore it's a better sign of what? A reversal and a bearish takeover than a confirmation of continuing bullish trend. Same would be true on a very low RSI. If RSI, you don't see it there, but say got into the 30 level, that would be closer to the bearish end zone, oversold. A better indication that the bulls are about to run and take over and reverse the bullish trend. Because markets really reach these levels of becoming overbought and oversold based on volume, and that's what's built into these indicators. And what I hope to do is get you to think about the stages of development that markets go through, and then you can apply, after using the moving average concepts that we talked about, indicators to help sharpen your execution. Question back here earlier was, how do you know that you're not, I think the question was, wouldn't you be participating versus anticipating? I'm anticipating market action during stage one, but then I'm going to use also tools like RSI to confirm my bias. So if I have a bias that we're coming out of a stage one, moving into stage two based on the moving average relationship that we talked about, and RSI is showing oversold conditions, low 30s, then I want to feel very strong that they confirm. And I want to start thinking about being more aggressive about entering my long positions and anticipating stage two development. And when you have those days where markets really start to break out in price above its moving averages, and RSI is confirming deep sold off levels, which you see right here, in this case, we're looking around 45 on the RSI, these are good indications as well that stage one is maybe mature and we're anticipating early stage two. So what we have to look for is, are we really there or is it a false signal? And this is where the RSI really becomes important, because we're looking for these deep oversold signals to confirm stage two. But an oversold RSI signal in the absence of knowing where the market is in terms of stage development, or at least anticipating where it is really a blind signal. So they don't make the decision, they only confirm. And in this case, when markets can start breaking out over their moving averages and you've got low RSI indications, you're getting good confirmation that stage two may be in its early stages. And that's enough statistical edge to make the trade. It's enough. It's not everything you need, but it's enough. This morning when I traded live, we were putting on some futures trades. All I was thinking about all day long was, what stage are we in? What's this look like to me? And what's the market telling me in terms of its price volume? A little tougher with futures, by the way, but stage development was the one thing that drove my mind all day when making those trades. And I recognized I want to be buying pullbacks all along this stage two markup stage, which I believe we're in right now.
Even though ADX was retrending?
ADX is too microscopic on an intraday basis. We want to look at that on a daily chart only. And I'm glad you brought that up because I didn't cover that point on time. The directional movement indicator in ADX is a tool used for daily charts. Do not apply it with anything inside that, because if you remember, what Wilder was measuring was higher highs from day to day and higher lows. It is not measuring higher highs and higher lows intraday. So therefore, intraday development is irrelevant to the indicator. Only daily charts should have ADX on them. I'm glad you brought that up. So we're just getting an idea of how to bring together some tools. Here's Biogen, by the way. Biogen, and by the way, don't read these levels literally. A lot of books say that, 70 and 30 are those magic levels on RSI. But that's just a very generalized statement. You want to look at those levels relative to the issue that you're looking at. For example, if an issue has the propensity to get into the low 20s or below 30, like Biogen does, this is where Biogen starts to come alive in its oversold indication. There's no literal number with any stock. If you're looking at a stock like, say, Intel, and Intel consistently looks oversold at 40, then that's the level. Not 30, not some literal interpretation, but relative to the issue that you're comparing it against. But more importantly than the indicator, what I'm trying to really get across is what's it measuring and what's the psychology behind it. What's it measuring? It's measuring number of up days versus number of down days, and the percentage of gains on the up days versus the percentage of losses on the down days. That's why it's called relative strength. And if you can understand that, then you can understand what the indicator really wants to try to measure. And this is where these signals become very important. Look here. When we start getting into the 28s, 27s, 28 levels over the course of 3 days, these are really nice indications that the market's becoming oversold. And they acted as great precursors to the rally that ensued. So I'm anticipating, even though price has not yet reacted yet, price is still at this 36.28 level. It did gap down, by the way, in this particular trade, but stay within this tight range. of accumulation, but as the market started to break out of its levels and make higher highs each day, very nice rally ensued. You know, these are $3, $4 moves. That's what you're looking for. Recognizing when are they moving from stage 4 to stage 1 or stage 1 to stage 2 or whatever the scenario may be. RSI helps sharpen that indication, but they work together. You don't want to use anything independent of itself. There's just a little picture of Biogen. And again, are we in stage? Now, I purposely asked the question, stage 4 decline, big question mark. Are we? Did we distribute our shares? Are we declining now? Or is Biogen really in a continuation of stage 3 and it's going to set up for another run and actually be an extension of stage 2? Well, the RSI will help sharpen that indication. So, for example, if in this case RSI was kind of in the 50-yard line, but selling off, muted indication. Would not be confirmed in my mind that we really are going into a stage 4. I'd want to see RSI start to come in hard and start to really retrace. And I'd follow that trend down, but once it start reaching these 30 levels, that's where I'd be looking for the game to be over on the stage 4 decline, and at least trying to find some recovery, even if it was just intraday in the oversold territory. So these start to sharpen, where are we within this range? And then there's all kinds of ways that you can trade this from here. A day trader might trade the support resistance in the downtrend all the way down. A day trader may buy all this support even though in a downtrend. So you don't have to just trade the trend even though overall stage 4 decline is likely. These are great buys intraday. So what we begin to see is now intraday day trades that can exist within these trends where you're actually fighting the trend by buying support, whereas the swing trade is saying the trend line is better to be followed than it is to be faded. And now you've got two approaches to the market that you can apply on different time frames. And this is why day trades and swing trades are very different. You can apply both approaches with a little bit different methodology. Thanks very much. You guys